The biggest mistake high income earners make isn't working too little, it's paying too much tax. I discovered a UK government scheme that lets you invest £10,000 in UK startups and immediately get £5,000 back from the HMRC. But here is the part that nobody talks about. If the startup fails completely, you can claim back £2,250 back in loss relief. That means your maximum downside is just £2,750 on a £10,000 investment, while your upside remains unlimited. This isn't some complex tax loophole. This is called SEIS Enterprise Investment Scheme, or SEIS, and it's specifically designed for people earning over £100,000 and other sophisticated investors who want to slash their tax bill while investing in high growth startup companies based in the UK. Hello, I'm Suman, and if you are new here, I document my journey of building wealth in the UK as someone who moved here from India. Today I'm breaking down the SEIS Enterprise Investment Scheme, or SEIS scheme, what I consider to be the most powerful tax efficient investment opportunity available to high income earners in the UK, especially if you are earning over £100,000 annually. In this video, I will show you exactly how SEIS scheme works, the 5 incredible tax benefits it offers, and why it's specifically designed for sophisticated investors who can afford to take significant risk with their investments. While I haven't personally invested in SEIS yet, but I have been investing in other startups and a similar scheme called EIS over the last 2 years. I have been researching this option extensively as a part of my investment strategy for 2025. And I am sharing everything that I have learned with real numbers and examples. So what is SEIS? SEIS stands for SEIS Enterprise Investment Scheme. It was introduced by the UK government back in 2012 to encourage investment in early stage startup, high risk companies by offering remarkably generous tax reliefs. Now here is what makes SEIS special. It's specifically designed for very young startups. To qualify, a company must be less than 3 years old, their gross assets will be below 350,000, and they are not listed on any stock exchange. These are genuinely early stage businesses, often pre-revenue or just starting to generate their first sales. Think of companies building their first product, testing market fit, or just beginning to scale. What many people miss is that these restrictions actually work in your favor as an investor. They ensure that you are getting in at the very early stage where valuations are low and growth potential is the highest. The government knows that these investments are risky. That's precisely why they offer such generous tax incentives. But let me be absolutely clear with this. SEIS investments are extremely high risk. The statistics show that around 60% of SEIS funded companies fail to secure additional funding or reach profitability. By some estimates, up to 90% of startups ultimately fail. This is why SEIS is primarily suitable for high net worth individuals who can afford to lose their investment capital. Let me walk you through the 5 incredible tax benefits SEIS offers. I will use real numbers to show you exactly how this works. The headline benefit is immediate tax relief of 50% of your investment amount. This means if you invest £10,000 in an SEIS qualifying company, you can reduce your income tax bill by £5,000. For those earning over £100,000, this is particularly valuable. As you know, for every £2 you earn over £100,000, you lose £1 of your personal allowance. This creates an effective tax rate of around 60% in that tax band. SEIS investment can help you reduce your taxable income and potentially recover some of that lost allowance. Now let's look at a concrete example. Imagine you are an additional rate taxpayer earning £150,000 in a year and you invest £20,000 in SEIS eligible startups. You would receive an immediate £10,000 reduction on your tax bill. This effectively reduces your taxable income to £140,000. The second advantage is capital gains tax exemption. Any profit you make while selling your SEIS shares is completely capital gains tax free, provided you have held them for at least last 3 years. Let's say your £10,000 investment grows to £50,000 over 5 years. That's £40,000 gain, which would normally incur a capital gains tax of up to £8,000 for additional rate taxpayers. Now with SEIS, you pay absolutely nothing on that gain. The third advantage is loss relief against income tax. This is where SEIS really shines compared to other investments. If your investment performs poorly, you can offset your loss minus the income tax relief you have already received at the beginning against either your income tax or capital gains tax bill. Let me show you how powerful this is. If you invest £10,000 and the company fails completely, you have already received £5,000 back in income tax relief. Of the remaining £5,000 loss, you can claim relief at your income tax rate. For a 45% taxpayer, that's another £2,250 back. This means your maximum downside risk is just £2,750 on a £10,000 investment. That's a 72.5% protection against loss. Meanwhile, your upside potential remains unlimited. The fourth advantage of this scheme is capital gains reinvestment relief. If you have realized capital gains from other investments, you can eliminate 50% of the capital gains tax due by reinvesting that amount into SEIS qualifying companies. For example, if you sold some shares and made a £100,000 gain, you would normally pay £20,000 in capital gains tax at the 20% rate. By reinvesting £100,000 into SEIS companies, you can now reduce that capital gains tax bill by 50%, saving another £10,000. By the way, this shares investment and capital gains tax, this is only applicable if you are doing the investment outside your ISA or SIP allowance, because within those tax wrappers, you don't need to worry about capital gains tax. Now, coming to the fifth advantage of the scheme is inheritance tax relief. SEIS investments held for at least 2 years qualify for business relief, making them exempt from inheritance tax. This means you can pass on these investments to your heirs free from the usual 40% inheritance tax. When you combine all these benefits, SEIS offers what I consider to be the most tax efficient investment opportunity available in the UK today for high income individuals. Now let's discuss about differences between SEIS and the EIS scheme. EIS is SEIS older sibling designed for slightly more established companies. You get 30% income tax relief versus 50% relief for SEIS. You have capital gains exemption on the gains, same as SEIS. There is also some loss relief available, which is same as SEIS. Capital gains tax deferral rather than exemption like SEIS. Here you have higher investment relief, that is up to £1 million versus £200,000 for SEIS. For high income investors, the optimal strategy is often to utilize your SEIS allowance first before moving on to EIS investments, as the tax benefits are a lot more generous with SEIS. So how do you actually find SEIS investment opportunities? There are three main routes. The first one is equity crowdfunding platforms like Crowdcube or Seed RS allows you to invest directly in SEIS eligible startups with minimum investment as low as £10. These platforms are regulated by the FCA and they provide detailed information about each of this opportunity. The advantage here is control. You choose exactly which companies to invest in. The downside here is that you need to do your own research, which can be time consuming and not very easy for a beginner investor. The second option is SEIS Fund, which are managed by professional venture capital firms who select a portfolio of startups on your behalf. Minimum investment typically start around 10,000 to 20,000 pounds. The advantage here is professional selection and diversification across 5 to 10 companies. The downside here is higher fees. Typically, it's around 2% annual management fee plus some share of the profits and less control over which specific companies you are investing in. The third option is through angel networks. Angel investor networks connect you directly with the founders seeking investments. This approach requires more capital, typically is 25,000 plus per investment, and more hands-on involvement. This is something that I am planning to do this year. I got involved with an angel network and they were considering investing in a new company which aligns with the area of my own job role as a doctor in the NHS. So they offered me to join as a medical advisor and investor in this company. Now this was a pre-seed investment and the company was not even formed at this stage. Through this option, you can be directly involved in the company and have a lot more control in the running of the company. For most high-income professionals looking to start with SEIS investing, I would recommend beginning with either equity crowdfunding platforms or SEIS funds, depending on how hands-on you want to be with your own investments. Due diligence, what to look for before investing in any SEIS opportunity. Here is what you should be looking for. Number one is SEIS Advance Assurance. First, check that the company has received SEIS Advance Assurance from HMRC. This confirms that the investment should qualify for tax relief. Most platforms will clearly indicate this. Number two is the team. The quality of the founding team is crucial for startup investments. You need to look for relevant industry experience, previous startup success or constructive failure, complementary skills among the co-founders, skin in the game. Have they invested their own money in this company? The third thing to look for is market opportunity. Evaluate the market size and growth potential. Is the problem they are solving significant? Is their solution genuinely better than other existing alternatives? How large is the potential market? You need to do your own due diligence for this information. Number four is traction and validation. Even early stage startup should show some validation. Customer testimonial or early user feedback, initial partnerships or pilot program, revenue if any at all, though many SEIS companies are pre-revenue. Number five is valuation. Be wary of inflated valuations. For very early stage SEIS companies, valuations typically range from 1 to 3 million. Anything significantly higher needs strong justification. Remember, you are not just investing for tax benefit. The underlying business still needs to have potential for success. Claiming your tax relief for SEIS investments is quite straightforward. After investing, the company will issue you a SEIS 3 certificate once they have been trading for at least 4 months. This typically takes around 6 to 12 months. Once you have this certificate, you can claim your income tax relief either through your self-assessment tax return filing or by asking HMRC to adjust your tax code, or you can write to HMRC to claim relief for previous tax years. Remember, you can claim relief against either the tax year in which you made the investment or the previous tax year. This flexibility is particularly useful for tax planning purposes. Keep all documentation related to your investment, including the proof of payment, share certificates, SEIS 3 certificate, and the SEIS form. Next question is, how much should you invest in this SEIS scheme? The maximum that you can invest in a year is £200,000. But how much should you actually invest? For most investors, I recommend allocating a 5 to 10% of your total investment portfolio to SEIS and other high-risk investment. Within that allocation, consider diversifying across at least 5 to 10 different SEIS companies to spread your risk. For someone earning over £100,000 annually, A typical SEIS allocation might be £10,000 per tax year, depending on your overall financial situation and risk tolerance. A point to remember here is that SEIS investments are illiquid. You should expect to hold them for 5 to 7 years or even longer. Only invest the money that you won't need access to for the foreseeable future. Now let's discuss some real world success stories of SEIS investments. Now I haven't personally invested in SEIS yet, but there are numerous success stories worth highlighting. The first one is BrewDog. BrewDog raised early funding through equity crowdfunding with SEIS as well as EIS relief. Early investors saw returns exceeding 2,700% when the company was valued over £1 billion. Another famous one is Monzo. This digital bank raised its seed round through Crowdcube with SEIS relief available. Early investors have seen their investment grow by over 1,900%. Revolut is another fintech success story for early Crowdcube investors with SEIS relief. They have seen tremendous growth as the company reached a valuation of $33 billion recently. Of course, these are exceptional cases, not the norm. For every success story, there are many failures, and this is why diversification and the tax reliefs are so important. SEIS offers an incredible opportunity for high-income US residents to support innovative startups while enjoying remarkable tax benefits. The combination of 50% income tax relief, capital gains, tax exemption, and downside protection loss relief creates a risk-reward profile that's hard to match with any other investment. For those earning over £100,000 in particular, SEIS can be a powerful tool for reducing your tax bill while diversifying your investment portfolio into an exciting asset class. Just remember, startup investing is inherently risky. The tax benefit help mitigate that risk, but you should still approach it with a portfolio mindset and only invest what you can afford to lose. In the comments, let me know if you have any experience with SEIS investments or if you have any questions about specific aspects which we have covered in this video. If you are interested, then I'm happy to invite some guest speakers from SEIS funds. Let me know in the comments below. Please don't forget to hit the like button and subscribe for more content on UK investing and tax optimization strategies. Thank you for watching this video, and I will see you in the next video.